Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 346 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about ultimately the new COVID variant that is, coming out and that is being announced, and that they're, trying to find out more about how that is affecting markets and how it might affect markets moving forward, and ultimately affect the way that you invest moving forward. So I want to talk about that, and then just the overarching idea of what you can do when it comes to crash proofing your portfolio, what you can do to take risk off the table, and whether or not you should even think to take risk off the table in the first place. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So just the thing that no one wants to hear is that a new COVID variant is being discovered or being found out, or is coming into the know of the medical community. And on Friday we saw a pretty staunch market reaction to this being the case, and we even had the president shut down travel from some of the southern Africa countries, because South Africa is where they say that this particular variant is showing up. And so all these things are happening, but we see a very staunch market reaction, right? The market was down over 2% in the major averages on Friday. And it really made me think, so many people worry about stock market crashes. So many people have seen stock market crashes happen. I mean, just last year, right, we saw a crash of over 30%. Now, this isn't the biggest crash that we have ever seen by any means, but it is substantial nonetheless. And these substantial crashes, they can have some very large impacts on not just our portfolios, but on our investing behavior in and of itself, right? The way we act about our money and our investments. And so I want to help you guys to stay on the right track. I want to help you to stay in the right place with your money. And I want to help you to make the right decisions over the long term with your money, right? And so ultimately, what can we do? What could we do when it comes to maybe crash proofing our portfolio from this, what's it called, the OMICRON variant, right? That's what they're calling it now. First off, I don't think that most of us should do much, right? I don't think most of us should change the way in which we invest just because of a news event, right? Now, albeit this news event can have some far-reaching implications, for sure, right? We've seen that COVID has had far-reaching implications, but let's just say that, you wanted to take a bunch of risk off the table in February or, January of last year when we were first hearing about COVID-19 in the United States. Let's say you decided to take a lot of risk out. I mean, you would have missed out on some fantastic gains to the upside if you would have taken a lot off of the table back then. And I don't want any of you to make decisions based on macroeconomic, decisions. Because ultimately, when, let's say, a president gets elected, right? It has always been a bad idea to try to trade around a president being elected or guess which president is going to be elected or whatever, because, most of the time it's a toss-up as to whether you're right or not. And then on the other side, you don't know what the reaction is going to be. Everybody thought that the stock market was just going to crash and be horrendous when Donald Trump got elected to be president. Well, that night, the futures were, horrible, but then on the back end, there was a very good stock market reaction to the fact that he was president and that he was business friendly. He was lowering corporate taxes, all those types of things. Regardless of what you think about that, I feel the same way about any COVID variant. I feel the same way about anything that the Fed might choose to do. Over the long term, what's the impact going to be? And over the long term, am I going to benefit by being out of the market and out of risk assets, or am I going to benefit from being in risk assets? And I think the overarching answer to that question is I'm going to benefit from being in risk assets. I think that we should all maintain whatever strategy we have and not let our strategy just go awry based on the fact that there's this new variant or the fact that there's new information out there. Now, may this impact the type of individual stocks that you want to select if you buy individual stocks? Absolutely, right? This could 100% be the case, because buying individual stocks is not like buying an index fund, right? Buying individual stocks has to do with the risks associated with that company, the risks associated with that particular stock. And if the risks associated with a new COVID variant are ones that just outweigh any of the potential upside of holding that stock, then I don't know if holding that stock's a good idea. Or if you think that there are stocks that are going to just thrive on the fact that a new COVID variant might be out there, then maybe you make an investment decision with that as a part of your premise, right? You don't want that to be your complete premise, because then when things change, because things do change, as we've seen, right? Then when things change, then your whole investing premise goes awry, right? And that is not what we want. We want good long-term investments that we can keep pouring money into. And ultimately, if you're putting money into, like I said, index funds, mutual funds, ETFs that are index-based or just, broader market type funds, I don't think you need to worry about this at all. I think you need to keep putting money away. You need to keep making sure that you are keeping to your investment schedule, your investment strategy that you have assigned for yourself. And if you don't have an investment strategy, if you don't systematically invest, then you need to be doing so. If that's where you're at in the financial action plan, that's where you're at in your financial life, right? You need to be doing that to make sure that you grow money systematically for yourself over the long term. Now, something that everyone needs to make sure that they do, right? Because I talked very recently about the amount of risk that we take. I talked about that last week, right? Are we taking too much risk? Are we taking too little risk, right? What can we do? I think we all need to make sure that our risk tolerance is properly mirrored by our portfolio, right? I think we need to make sure that our time horizon, our objective for investing, and our risk tolerance needs to be properly displayed in the way that we're investing, right? I talked about that last week when I talked about how much risk that you're taking. Those are the three things that should determine how much risk you take in your portfolio. And if you don't have those things properly aligned and a crash does occur, right? Or you see just a prolonged downturn or, whatever it may be, right? And I'm not suggesting that any of these things are going to occur. I'm just saying, hey, we saw a big market reaction on Friday. We don't know the full extent to which this can have an economic impact. And so we are going to wait and see, but we need to be prepared nonetheless. And so if your portfolio doesn't properly adjust for, what you're investing for, how long you have to invest, and your personal risk tolerance, then you are likely to make bad decisions if a market crash is to happen. Right? And that's not what we want, right? We want you to make the right decisions. And the only way that you're going to make right decisions is if you can, with a clear head, look at things and go, okay, based on the fact that, I have everything lined up the way that I need to, I can decide what to do with my portfolio. I can make these decisions, because at that point, you're not taking too much risk. You're not taking too little risk. You're taking the proper amount of risk, and then some exogenous event, some event from the outside occurs, and then you can decide what you're going to do from there. But in most cases, what you should do from there is just keep buying. Right? What you should do from there is not get lost in the minutia of any negative event. Look, I lived through last year just like many of you did. I invested through last year just like many of you did. Right? The stock market crash is no fun. It was no fun. Right? And we saw it occur right in front of our eyes. But what could you do? Right? You could have either sold. Right? You could have just sat on your hands, or you could have bought more as the market crashed. And I did not sell, right? Because selling is a bad idea, right? Again, unless it, whatever the crash is because of, breaks the premise of your entire individual investment you're making, which will only happen if you're buying individual stocks. Then I did sit on my hands for a little while and watch the market do its thing, but then I bought more, and we should all do those things, right? At the minimum, we should sit on our hands, but to maximize what we're going to do, we should buy more, right? We should continue in our buying process and maybe even buy a little extra if the market crashes over a certain amount. Right? And we need to be prepared to do so, right? Be prepared to have some cash on hand to invest in that way. And if you aren't prepared and you don't have extra cash on hand, that's okay. Just continue with your systematic investing and you will buy at lower prices, which is what we all want, right? We want to buy at lower prices. But again, if your risk profile is not properly taken into account, then you're going to make bad decisions. And we don't want you to make bad decisions. Therefore, make sure your risk profile is properly showing up in your investments, and then you will make proper decisions if there is to be some prolonged downturn or some prolonged crash. Now, would it be prudent for somebody like myself who is heavily in risk assets, or somebody who has a risk profile that is heavily in risk assets, to take more of a safety approach, to take more of an approach that is going to take some risk off the table, that's going to, maybe provide you more stability in your portfolio? Is it worth it to do that at this point? And in my opinion, no. Right? In my opinion, we are not out here trying to time the market, right? And that's one of the biggest things that I have to convey to you about these market crashes is that it's not about timing the market. Long term, nothing is about timing the market. It's about time in the market. Now, don't get me wrong. You could begin investing at a horrendous time, and you can't help that, right? But the number one indicator of you having money that you can live on over the long term is not the rate of return that you make, right? It is the amount of money that you are investing and the fact that you are systematically investing over a long period of time. But again, it is not timing the market, even though it can have an impact. It is time in the market, right? It is how long you are investing. Right? Because the longer that you are investing, the longer you have money in the market, the longer your money can compound and the more it can grow up and up and up. That's one of the biggest factors when it comes to the growth of your money is your time horizon, is how long do you have, right? Warren Buffett is a perfect example here because Warren Buffett, yes, he blew out the market for many, many years, but he hasn't really done a whole lot in the last 20, 25 years as far as beating the market. He's made good returns, but not abnormally great returns, right? But the fact that his wealth has grown to the amount that it has a whole lot to do with the fact that he has just spent many, many years in the market. He spent many, many years doing this thing, right? Where he's just systematically investing, making sure that he stays in the market, right? He's an owner of a company, right? Just stay in the market, allow your money to grow over the long term, and you will be okay. He has stuck to that. So for him, time in the market has been far more effective than timing the market, right? Because he doesn't do a whole lot of market timing, right? He may buy things at advantageous prices, but there's a lot of times where he's chosen not to buy things at advantageous prices because he's like, hey, I'm already fully invested. I've already got these good investment ideas over here, these good investments that I'm executing on. Why would I go about trying to do this when I can just do all those things? And I think that is the prudent thing to do for the vast majority of us. And the empirics back this up, right? The returns, the percentages back this up. So let's just say that you invested $2,000 annually in a portfolio that tracks the S&P 500, right? So an S&P 500 index fund from 2001 to 2020. The individual who never bought stocks in this example invested in a hypothetical portfolio that tracks the U.S. 30-day Treasury bill index, right? So they stay in cash, but it's T-bills, okay? Now, if you looked at what happened over a 20-year period from $2,000 annually in this portfolio, if you time the market perfectly, right? Meaning that you bought at the perfect time each year, right? You bought at the perfect lows every single year, right, and did so as you continued to move forward, right, then you would have had $151,391 over that 20-year period. Okay, not a bad little nest egg. That's perfect timing. Well, let's say you invested immediately, right? So every year you just immediately invested as soon as the year began, right? You just immediate investment. You would have had $135,471. Well, let's say you dollar cost averaged the money in over the course of the year, then you would have $134,856. So about the same as investing immediately. Then let's say you had bad timing, right? If you had bad timing, you would have $121,171, right? So that is the worst of the worst timing in the market here, right? That's picking the worst time to buy every single year. But if you would have stayed in cash, you would have only had or in the T-bills, right? You would have only had $44,438. So being invested, being in the market is far more valuable than having the perfect timing, right? Because even with the worst timing, you far outweigh the staying in cash option, right? Because there are so many people that you'll hear say, I was in the market, but then, the financial crisis happened and then I sold everything and I just never got back in. Well, never getting back in costs you a lot of money. And when I say a lot of money, I mean a lot of money, right? And we can see this in this particular example. It costs you a whole lot to be out of the market. So what's the whole point here? The whole point here is that even if the market is to crash, right? Even if the market is to have a staunch correction, which could definitely happen as well on the back of this new variant, then being out of the market is not going to be valuable, right? And stopping what you're doing as far as your systematic investing program is not going to be helpful. Just continue to buy, continue to buy, continue to buy. Take the dollar cost average or invest immediately idea, because you're not going to be able to perfectly time the market, right? So dollar cost average in, continue to pour money in systematically, and guess what? Over the long term, you will continue to build wealth. Even if it's not at the perfect rate of return, you will continue to build wealth, because especially amidst a crash, the buying opportunities are aplenty, right? So just take advantage of those buying opportunities. The worst thing you can do is to sit on the sideline, and the next worst thing that you can do is to never invest at all. Because I know that many of you think that, bear markets are far worse than bull markets, and that just couldn't be further from the truth, right? I know that we've been in a roaring bull market, other than the crash in March of last year, but, we shook that off quite quickly and continued upward in a very aggressive fashion, right? So we've been in a staunch bull market for a long time, other than that crash. And this bull market has continued to last and has been very profitable for a lot of people. But for some reason, people are more scared of a bear market than they are excited about the bull market. They just expect the bull market to happen and continue, but they don't expect the bear market, and the bear market punches them in the teeth. And that should not be the case, right? These bear markets, even though they seem bad at the time, right, they're not that bad, right? And the returns are not that bad, even though they feel as if they're that bad. Because we all know that, let's say you lose half of your money in, the market, right? You lose half of your money over the course of a horrendous crash, right? Well, in order to get back to the amount of money that you had previously, you would have to make not 50% back, right? You'd have to make 66.67% back, right? You would have to make greater returns to the upside than you did to the downside just to get back to where you were at, right? But the bear markets are not so bad that the bull markets don't take care of that quite quickly for all of us. So if you just look since 1942, right? Since 1942, what have we seen from bear and bull markets, right? The average bull market has lasted 4.4 years with an average cumulative total return of 154.2%, okay? Which is outrageous. That's absolutely fantastic, right? Then the bear markets have lasted on average 11.3 months, right? So 4.4 years versus 11.3 months with an average cumulative loss of only 32.1%, right? So the bull markets are far outweighing the bear markets. And so here, you look since 1942, the number of bull markets you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 bull markets, right? You have 14 bull markets. And then bear markets, you have, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 bear markets, right? But the bull markets are far, far greater. And the bull markets continue upward far, far longer and far, far more aggressively than the bear markets do. So being out of the market or not remaining in risk assets is just a bad idea. It has always been a bad idea. It will continue to be a bad idea, right? The only way that this is not a bad idea is to say that the United States economy isn't going to grow, or just the world stock market isn't going to grow, which is not likely, right? It is not likely at all, because ultimately, what are corporations trying to do at their baseline? They are trying to create value for shareholders, and nobody's done that better than some of the major companies in the United States over time. And you're saying, well, what if the United States economy doesn't do that well? Well, buy a world stock market index, right? Because the largest companies in the world are going to do well, right? And the best companies in the world, the companies in the world that are the most innovative, are going to do well over a long period of time, regardless of what you think about the macroeconomy in which they operate, okay? So bulls and bear markets, bulls, they just absolutely dominate. So there's absolutely no reason to stay out of the market, even if you think that a crash is going to occur. Then, if that's not enough for you, if you just looked at rolling 10-year returns, meaning if you took from 2011 to 2020 or 2012 to 2021 or whatever, right? You take all of those 10-year periods over time and you say, okay, what have the returns been? Now I have the data here through October of last year, right? Which leaves out quite a bit of upside gain, but let's just take from October of last year and see what we have here. So over the long term, 10-year average returns, right? 10-year returns in the S&P 500 since back in 1936, right, is the first year that we have in this data. If you take from 1936, there have been, let's see, 1, 2, 3, 4, 5, 6. There have been 6 negative 10-year rolling return periods, right? And that is out of, how many rolling year periods do we have there? Nearly 80. You have, I think, 75 10-year rolling periods there. And only 6 of them have been negative, right? So if you think that the stock market is going to be down over the next 10 years, then you are likely wrong, right? If you want to stay out of the market for any period of time, the next 10 years is likely never a good idea to stay out, right? And, the next 5 years is not a good idea. The next 3 years is not a good idea, right? Because the market is positive more often than not, and especially so over a 5-year period or a 5-year plus period. That's why I say when you're going to invest for anything, make sure you can invest for at least 3 to 5 years, but 10 years, even better, 20 years, even better. But over the long term, the 10-year averages have been 10.32% per year, right? So you're telling me not only are you going to get out of the market for some crash because of something that may occur, right? But you're also going to give up 10.32% per year on average over that 10-year time period, the next 10 years, right? I'm just going to say you're probably not going to choose to do that, and you probably should not choose to do that, right? We just need to be logical about what we're thinking here. I know that most investors and most people who have already rode out the storm with COVID and they've already invested through it, they're probably listening to this episode going, why? Why do I need to hear this? Why do I need to know this, right? Why is this important? Well, this is important because there's also a lot of investors out there who have had some very negative thoughts, and especially recently as the stock market continues to look more and more bubbly, the prices continue to go up and up. They're just waiting for the shoe to drop, right? They're waiting for the moment when the stock market will finally correct, right? And finally, the valuations will drop substantially and the market will crash and all these things. People are waiting for this. And I'm specifically talking to you people, right? I'm specifically talking to you and telling you that even if you think that the market is going to crash, you're likely wrong. First off, right? You're likely wrong because most people don't predict crashes correctly. And even if you do predict a crash correctly, right, remaining conservative on the other side of a crash is a bad idea. It is a bad idea to not continue to stay invested. It's a bad idea to not be invested on the other side of a crash, because ultimately the best thing to do during a crash, as we've seen historically, is to buy. It is not to sell. It is not to be in cash. It is not to be in conservative assets. It is to get into risk assets, to do so aggressively and continue to buy over time. And look, you do what you want to do, right? I'm not going to keep you from doing what you want to do, quite obviously, right? You can do what you want to do. But if you want to maximize what you're going to make in your investments over a long term, you need to be a net buyer at all times, right? You need to forget about the fact that crashes could happen, because crashes will happen. And you know what I'm going to be doing through every crash? I'm going to continue to buy. And you know when I made money, some of the most money and the most returns I've made in the stock market over my investing life, which is not extremely long at this point, is when I was buying at the bottom of the coronavirus crash, right? And you can make money in that way too, but that's not the only way we should be making money. We should continuously invest. We should continuously pour money into our investment accounts month after month, paycheck after paycheck. Whenever you get paid, put money away, right? And you will dollar cost average your way to wealth, right? But you can make some big abnormal returns, have some big abnormal gains if you put some extra money in when you do see crashes. And look, am I suggesting that a crash is going to occur? No, I'm not, right? I'm not suggesting that at all. I'm just saying that for those of you who think that that's what's coming, and you think that, another time of the coronavirus stuff hitting us or the COVID stuff hitting us is going to be too much for the markets to stand, I'm just wanting you to know that you're wrong, right? I'm just wanting you to know that this is not, probably going to happen. And even if it does, right, then I'm going to continue to be on the right side of investment history. And I want you to be on the right side of investment history with me too, because just like you can't predict when, a crash is going to occur, I can't tell you that a crash won't occur, right? I'm just telling you, statistically over the long term, it's been far less likely that a crash does occur than if it doesn't, right? And it's been, historically shown that corrections are quite common. So if a correction happens, we're down 10% or whatever in the short term, then I won't be surprised, right? That won't be surprising to me that some market uncertainty causes that when we have high valuations. But again, what am I going to do? I'm just going to keep buying and buying and buying and making money and making returns. And I would suggest that you do the same. Make sure that your risk profile is right. Don't do anything dumb. Don't do anything rash. Some of you may have done some rash things on Friday when the market was losing its mind. I just wanted to get ahead of this and tell you guys that you can make the right decisions now and not be too hurt, right? Even if you've already acted, you can, you can react, right? You can continue in the way that you were going by correcting whatever stupid trades you may have made on Friday, right? But those who haven't acted yet and were thinking about it, those are who I really want to stop. And I want to make you think about the long term. I want to make you think about what works over the long term and not about just day trading or whatever else you're trying to do in your portfolio. Look, you don't lose money until you sell. Okay. And I know it doesn't feel like it when the value of your money is going to debt. And I know it doesn't feel like it when the value of your money is continuing to drop day after day, week after week, but you don't lose money until you sell. And we've had a great run upwards, and we've all enjoyed that great run. But don't be surprised at the market's ability to be resilient. Don't be surprised at the market's ability to make new highs even when you think that it shouldn't. Because let me tell you, as an investment advisor representative in 2017 and 2018, I had more than my fair share of people telling me, my clients telling me, that the market was going to crash. I had more than the fair share of people telling me that the market can't keep going upward. And guess what it did? It kept going up, kept going up, kept going up, and has only gone down via a major market crash because of COVID last year, right? So just take that to heart, take that into your mind, and make the right decisions with your investing, and don't let this Omicron variant or whatever put a wrench into your long-term investing strategy. So thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.